All right, let's get right into it. We're going to break down the fundamental factors that have been driving Hitachi Energy India's strategic performance. We're focusing on the period from 2021 to 2026, which has really been a time of massive change for both the company and the entire energy sector.
So, let's kick things off with our first key area, the company's absolutely unprecedented position in the market. We're going to deconstruct how it managed to reach this historic valuation peak.
And when you look at the company's rise, it's been, well, nothing short of meteoric. We're talking about a staggering 1,500% surge in just 5 years, which topped out at a market peak of almost 26,000 rupees. Now, this isn't just random market hype. The market sees this as a reflection of flawless strategic execution, especially since the company's demerger back in 2021.
So the big question is, how did they pull this off? Let's unpack the core strategic pillars that have built this incredibly strong competitive position, what some analysts are even calling an impenetrable moat.
Okay, pillar number 1 is a really significant strategic pivot. We're looking at their Growth 2030 roadmap, and what it does is shift the entire focus away from just traditional hardware and moves it towards their high-margin Lumada digital ecosystem. It's all about smartly integrating operational technology with IT.
Then you have their sheer technological dominance, and this is a huge factor. Hitachi basically has an unrivaled grip on high-voltage direct current, or HVDC technology. And you've got to understand, this isn't just some product. It's the absolute non-negotiable backbone for India's massive national goal of hitting 500 gigawatts of renewable energy.
And as if that wasn't enough, a whole new, really powerful source of demand has just popped up. I'm talking about the explosive growth of AI data centers across India. These things are incredibly power-intensive, and that's created this huge surge in demand for the company's advanced transformers and its gas-insulated switchgear.
And the last piece of this puzzle? It's all about going global. Hitachi has just nailed its Make in India for the World strategy. We're seeing nearly 30% of their total orders now going out to serve these key growth markets, especially in Southeast Asia and Africa.
All right, so that's the strategy. But the real question is, how does all this translate into actual financial performance? Let's dive into the bull case and look at the hard numbers.
The bull case really rests on this one staggering number, a record order backlog of almost 30,000 crores. Now, this is such a critical metric because it gives them crystal clear revenue visibility for the next 2, even 3 years. It's all fueled by this captive industrial demand cycle.
And it's not just promises, the execution has been rock solid. We're seeing over 90% year-over-year growth in profit after tax. They're running a debt-free balance sheet, and they've got a really robust 21% return on capital employed. What this really tells us is that the earnings momentum is finally starting to catch up with that premium price tag.
Looking ahead, the future growth story is really backed by a multi-billion-dollar project pipeline. You've got these massive government initiatives like the Green Energy Corridor Phases 3 and 4, and these are expected to be huge catalysts, pushing those profit margins up towards the company's own target of 15 to 16%.
Okay, but every story has two sides, right? So let's flip the coin and look at the case for caution. It's time to assess the potential headwinds in the bear case.
The absolute heart of the bear argument comes down to one phrase: valuation froth. You're looking at a stock trading at 25.2 times its book value. That is way, way above its historical average. Now, a premium like that leaves zero, and I mean zero, room for any kind of execution mistake. It also makes the stock incredibly sensitive to risks like price swings in key materials like copper and steel.
And if we dig a little deeper into those risks, you see those high valuation ratios we just talked about and the potential for margin pressure from commodity prices. There's also a heavy dependence on government spending and policies staying the course. And of course, you always have the risk of project delays or major disruptions in the global supply chain for key parts.
So you've got this strong bull case on one side and these very real risks on the other. How do we put it all together? What does this synthesis tell us about where the company really stands strategically?
Well, this brings us to what the market seems to be saying so far. Despite all those valuation risks, the company, which trades as POWERINDIA, has shown what's called a low beta, high alpha profile. What that means is it has consistently beaten the Nifty 50 benchmark, really positioning itself as the primary long-term winner in India's massive electrification story.
And that leaves us with the one central question that everyone in the market is wrestling with. The company's strategic position, its tech leadership, that's not really in dispute. But does that justify a valuation that bakes in perfection? Is all of that future success, all of that flawless execution, already priced into the stock today? That, right there, is the fundamental debate.